Okay, these are I think the important conversations to have with your clients so they understand this guy is the professional when it comes to mortgages now. Now I know why. Okay. And believe me, I would have people like I would be playing hockey and different, not even fully dressed, and I'd have guys drag a guy across. If you're getting a mortgage, you got to talk to this guy. This guy's the only guy I know who knows anything about mortgages. Okay.
Joe is one of my favorite people. I have the pleasure of working with him day in and day out, which is just amazing. He's been around in the industry for a long time. Hall of Famer, lots of experience and awards under his belts, lots of high leadership positions as well. Most recently with corporate development with us at DLCG. Right, Joe?
That's correct. Yeah. Senior executive network development. I never got my business card done, but I think that's what it's supposed to say on it.
Yeah. And you've taught, I think, 15,000 or so students.
Yeah, I taught for about 22 years at Seneca College. I was one of the original group who taught. And some of you might remember there was like 14 courses in order to get a broker's license back in the day. So
Wow.
myself and Joe White that actually ran the program there at Seneca College. Joe was the program coordinator, and I took the courses to Conestoga College, Fanshawe College, other colleges across Ontario, and I taught all the mortgage financing courses, contract law. So I taught a lot of courses, but it was estimated to be over 17,000 students in Ontario.
That's crazy. And you're also the only person to be the MPC chair more than once.
I was the only person to be chair of the association twice, 2010, then again 2020.
So essentially, we couldn't have a more experienced person on the line to help take us through this great topic today. So I'm just going to let Joe dive right in and do his thing because he's obviously professional at this. So today we're asking him to break down how you would suggest speaking to a client about, the total cost of borrowing and explaining it in a very easy to understand way.
Okay. Okay. Cool. Yeah, it's not the most exciting of topics, and like we've got some time to spend together. So if there's any other topics that have to do in this realm of anything, like I'd be happy to add my 2 cents. And as usual, we learn from each other. Right? Like I said, I've taught 17,000 students, but I learned more from them than I could ever teach them. Right? So it's just learning from each other is what makes it special. Okay. So the idea of this effective cost of borrowing. So I'll give you an idea of the history lesson behind it. Because believe it or not, this form that we use, the disclosure to borrower, okay, it was actually called something else beforehand. It came about as part of the Mortgage Brokers Act when it was derived in 2006. Okay, I think it had royal assent in 2008 because I remember being there in Queen's Park when it all happened. Now, as the regulator, FISRA, okay, FISRA's mandate is really clear, right? They're not here to protect the mortgage broker industry as much as they're here to protect the consumer from the mortgage broker industry. Okay. And this form was really highly used or important for the regulator, especially when it came to private mortgages, mortgages that we have to charge fees, where there's, two lawyers involved and things of that nature, right? It just made it more important for clients to have proper disclosure around the mortgage that they're getting. Okay, so that's what it was there. And the other reason why it was so important is that if somebody goes to a mortgage broker and they're charging them this rate but this fees, and the other mortgage broker is now charging a lower rate but more fees, well, it's very hard for a consumer to say, okay, which one is a better value by way of a cost of borrowing. So it's a way to say, okay, you can take two different products and now you can compare it and bring it down to one cost, the true cost of borrowing. Then now you can actually compare one against the other. Does that make sense? Okay. As long as you know the data set, it's a math equation. Okay. So, but yeah, if there's stuff that you don't know until the end because you got to wait for the commitment to see something, then absolutely. Okay. How is it now, or what is the challenge you find? Is it an awkwardness when you get in front of clients and they go, "What the hell is this rate? I got a mortgage at like 5.2%. Why you me get into initials and sign something where the rate's considerably higher?" Is that kind of like the challenge that we deal with at sometimes? I'm getting some nods. Okay, all right. So let me explain it to you in a nutshell if I can. Okay, or the way I would explain it to a client. Okay, in a mortgage, anytime you get a mortgage, there's two costs associated with the mortgage. Okay. There's the cost of the mortgage which is the interest cost. And then there's a cost of acquiring the mortgage. Okay. So these are two costs associated. The interest cost is the cost associated, and then there's a cost associated with acquiring the mortgage. The regulator, for full disclosure, requires us to show both those costs in one rate, which is the APR rate. Okay, so let me break it down into a very simple example. Okay, so I'm looking, Martin's here in the middle of the screen. Okay, so let's say, Martin, I gave you $10,000, right, at 10% interest. We'll just make life easy, go simple interest, $10,000. Okay, at the end of that 1 year, how much is that mortgage costing you? $1,000, right? 10%, 10,000. Like I'm keeping it simple here, 1 year. I can say to you, this mortgage, Martin, is going to cost you 10,000. Okay. But then I'm going to say, oh yeah, by the way, I'm going to charge you $2,000 for this mortgage. And then I say, well, how much is this mortgage really costing me now? Well, it's costing me $3,000. So it's costing me 1,000, and the cost of the mortgage was is the interest. It's costing me $2,000 to acquire this mortgage. It's costing me 3,000. Brian's going to say, hey, hang on a sec. If I'm borrowing 10 and I got to pay you 3, this mortgage is not 10%. This mortgage is a 30% mortgage. Did I lose everybody? Everybody understand the rationale? So what is it really costing me to borrow that money? If I give in Martin 10,000, but he's only left with 7, which is the net advance that we see in our disclosure, you can't tell me this thing's costing me 10%. It's not costing me 10%. It's costing me 30 because the $1,000 interest fee plus you have the $2,000 broker's fee. This is what it's really costing me for the mortgage. This is no different than when you're doing a savings insured mortgage or any mortgage in which you have fees in there. Okay, it is that the interest rate is this 4.299%, but you have $4,000 in fees. We got to take that $4,000 in fees, add it to the cost of the mortgage for us to in order to establish what is the real cost of this mortgage expressed as an annualized rate. Okay, now I'm just going to look at the questions here because I don't want to get ahead of myself here.
Yeah, we have
Can I
first
give you
off,
the benefit of cost of disclosure? My question, do banks provide a cost of disclosure when a mortgage specialist at the banks do the knowledge? I've never seen a client see them. Okay. And here is the reason about. I think some banks are doing it, or at least they express some interest rate, the effective cost of borrowing, right? Which is basically the semi-annual rate expressed one time per year, which is law. But here's the thing with the banks, okay? The banks are not licensed individuals. They don't have to. They fall under the Bank Act. So in other words, when I go to a bank, the way the regulators look at it, if I'm going to the bank, I'm going there with the understanding that the bank is trying to get the best deal for the bank, and I'm there to fight the bank to get the best deal for me. Okay. When I come to a licensed individual, there's a fiduciary duty responsibility that lies with somebody being licensed. Therefore, we have a higher due of disclosure, of know your clients, a higher responsibility because we are a licensed individual. That's ultimately the reason why we have to have this. Okay, but this is a selling feature to yourselves when you meet with a client. I'm going to show you what it really, first of all, I'm going to show you how mortgages actually work, and I'm going to show you the costs associated with you acquiring the mortgage. Okay, and again, if you're doing a private mortgage and say the interest rate's at 12%, but you're charging that person 2% fee, and he goes, oh, this client here has a mortgage. It's like 11.5%. It's a better deal. Yeah, but he's charging you $2,700 fee. Which mortgage is more expensive? That the 11.75, 11 and a half interest rate at a $2,700 fee as opposed to a 12% interest rate, a $2,000 fee, that 11.75 is the more expensive mortgage because you break it down. This is the true cost of borrowing both these mortgages now. Okay. So, and I used to do like tons of privates. And again, I know how to do this on my calculator. I can figure out the effective cost of borrowing. I could, teach you guys one day if you want. It's not terribly complicated, but just got to practice doing it. And then you can actually like explain and show it to your clients. But again, this is a value you want to get to your clients. Unlike the bank, I'm going to show you how mortgages work and what is the true cost it's going to take you to do this mortgage. Okay. So again, the main point is that here's all the costs associated with the mortgage. So In order to acquire this mortgage, you also have to pay these fees, whether they're lawyer's fees, land transfer fees, and everything. People can understand here's the interest rate, here's the fees. The effective cost of borrowing is putting those together to express an interest rate. Don't go there and like back in the old days, you almost want to put your thumb on the piece of paper. Like, hey, don't worry about that. That doesn't mean anything. Don't look at that. Whatever you do, like look over here. Don't look at that. Okay. Be upfront with it and have people say that this is why it's important to deal with the mortgage broker. I'm going to tell you the true cost of borrowing this mortgage. Now, another thing to keep in mind is that the longer the term, okay, the longer the term, the less that cost goes because, or the interest rate goes down because those costs are no longer restricted to acquiring that mortgage for 1 year. If it's a 5-year term, those costs are spread over the term of the mortgage. Okay. This is why when you see a private mortgage and say it's a $10,000 private mortgage, okay, the example I gave that $10,000 at 10% for a $2,000 fee. Well, again, we can say the total cost of borrowing that money is 30%. That's a 1-year term. If it was a 2-year term, well, that $2,000 cost is actually divided over 2 years. So it's actually $1,000 1 year and $1,000 the next year. So all of a sudden, this mortgage that still had a $2,000 fee that was still at 10% interest, the rate goes from 20%, I'm sorry, from 30% down to 20% because it's spread over the term. Okay. That's why if you're doing a short term 1 year open, you find the effective cost is higher than if you had just turned it to a 5-year term, the effective cost is less because those costs are spread over the 5 years. Everybody got that? And that's something to explain to clients when you're doing short-term mortgages or private mortgages. Okay. Any good? Okay. Any questions with that so far?
Yeah, good questions here is which costs to include in the APR calculations and to
Okay.
disclose on the brokerage.
Now we do have a sheet here because I want to make sure I'm in line with exactly um, and I think everybody has it as well. But if you don't, let me get it up. Just good. And while I'm doing this, we're going to do a little quiz here in a minute, APR. And the quiz is truth and reconciliation a stat holiday in Ontario.
Joe and I just made a bet on this and I lost. Oh,
Lisa's got
we
it
got
right.
mixed answers. Okay.
Nope.
The
How many people think it's a stat holiday in Ontario?
most people are saying
Yeah, yeah. It's not a stat holiday in Ontario, but I was wondering why my calendar is so empty because I guess a lot of people are taking it off tomorrow.
it's not in Ontario and Quebec, you said?
It's not in Ontario and it's not in Quebec.
Okay.
Well, the other provinces apparently are. Okay. All right. So let me share the screen if I can. And I think this is where there's been a lot of confusion. And the confusion lies, uh, honestly, sometimes with what the regulator tells us. Okay. The rule of thumb, so to speak, is that you tell clients any cost that's associated with you acquiring the mortgage. Okay. So land transfer tax would not be an example of a cost because land transfer tax is a cost associated with acquiring the house. Okay. Lawyers' fees, lawyers. Now you can see the argument could be, well, lawyers are using to do the real estate transaction as well, but we can't close a transaction in Ontario without a lawyer. Technically, we can, but we'll get into that. Okay. Administrative charges. Yeah, this is a cost associated with me getting the mortgage. Lenders, legal fees. Yep, I got to pay this or else I don't get a mortgage. Appraisal fees and so forth. Okay. I have to pay this, so it's included. So you can see all this stuff's included, right? Now, whether it's deducted from the advance is something else because appraisal fees are, paid directly to the appraisal, title insurance, but they are included in the APR. So all these costs are included because all these costs are associated with me acquiring the mortgage. And I think that's how you tell your clients. Okay. When you get the mortgage, you got to pay 10%, plus you got to pay all these costs. And it's included when we come up with one interest rate. So another way of looking at it, well, I think I kind of explained it that way too. Yeah, like again, I don't have do the whole mortgage math calculator stuff, because I think it actually made it even easier to explain. Yeah, so stuff like overdraft charges, things like that, would not be included, right? And there's some nuances in the case of reverse mortgages and so forth. Okay. And again, no closing costs. Okay, like utility bills, land transfer tax, property tax, HST on purchase, legal fees. Like this stuff is not included. Where it gets a little goofy, to be quite honest, is some of this uh, legal fees, lawyer chosen by the borrower. Okay. It's kind of like it has to be in disclosure, but it's not included in the APR. If it's the lender's legal fees, they have to be included and have to be disclosed. So this is really like the nuance. No default insurance, none of this stuff. Where actually, to be quite honest, default insurance was once part of it, but it's no longer. Okay, so we'll get you this form. So you have everything that's called, and this is like the mortgage architect's way. Okay, so this is the way we're supposed to all follow.
Krista had a great question. She says she never separates title insurance with legal fees on the disclosure.
Yeah.
She puts estimated legal fees and disbursements. Is that correct, or should she be separating them?
They're saying that you should actually slice out, and I'm actually surprised if your file's being submitted that they haven't mentioned that to you, because you're supposed to be slicing out. What do you call it? You just said a title insurance.
Okay.
Okay, but I'll get this out before this call is out. I'll make sure Sarah has a copy of it.
hmm
Okay.
Another question here. Can you explain borrower legal fees?
Okay. In some transactions, especially in the world of private mortgages. Okay, so let's look at a real estate transaction. What typically happens when you have a real estate transaction, the lawyer is acting on behalf of the lender during a real estate transaction. We all know that, right? It's the lender wants, doesn't want your opinion on title, wants the lawyer's opinion on title to make sure that they have a good mortgage in place. That lawyer usually is always the same lawyer that handles the real estate transaction. Okay, so Lisa has a client. Here's the lawyer. And this is why the lawyer, you might think, oh, this lawyer is great. He does a lot of real estate transactions, but the lender might say he's not approved because we want him to be able to act on our behalf and we don't want, for whatever reason, might not want to. Okay, so that's a normal real estate transaction. The lawyer represents the lawyer, I'm sorry, the purchaser, and in acquiring the property also represents the best interest of the lenders. Okay, and this is when you go sign papers at the lawyer's office, they have one document there that clearly outlines that there is somewhat of a conflict here. I'm representing you to buy the home, but I'm representing the lawyer. And there's a form that they sign. Okay. Now, if I'm doing a private mortgage and the amount is say over $75,000 in Ontario, okay. So let's try to get some faces here. So we got Mandy who's got the $100,000, right? Who wants to put a mortgage out. Okay. She has Michelle, who's another client who wants the mortgage in. Okay. I happen to be the broker representing both parties, which you can still do. Probably not over 75. But Mandy would need her own lawyer because Mandy wants her lawyer to represent her to ensure she's putting out a good mortgage out there. And Michelle would need her own lawyer as well. So in those cases, when you get to private mortgages, like when you're talking to clients ahead of times, and some mix are even this fashion. Some mix will say, hey, you got to use this lawyer, we got to use this lawyer. Okay, so there has to be individual representation. But if I'm the one lending the money, or in this case, if Mandy's the one lending the money, I ain't paying for the legal fees. So the borrower, unfortunately, is going to have to pay for two legal fees. It's going to have to pay for the lender's legal fees, and then it's going to have to pay for the lender fees of the borrower as well. So it's usually in those situations, not limited to those situations, but that's the vast majority of cases that you would see it. Okay. Any other questions? Is there any other questions there? Oh, I see lots of stuff in the chat. Let me
Do
just see
you
what else.
have a online APR calculator you recommend?
There really isn't an online APR calculator. I mean, unless you go into Velocity, I think, and play around with that. Okay. But like you can almost do it in a round figures. Again, if the total, if it's a $200,000 mortgage and the interest rate's 7 or 6, say 5%. Okay, so you already got the $200,000 taken care of. It's the 5% is there. Okay, but it's $5,000 in fees. Okay, take that $5,000 okay, I don't know how complicated I want to get with here. Let me get like a round figure. Okay, let's see if we can do it this way. let's say a $200,000 mortgage at 7% is going to cost this person, say, 7 is going to cost them $9,000 a year in interest costs. Everybody okay with that? So a $200,000 mortgage, it's going to be $9,000 in interest costs. Okay, so whatever the monthly payment is times 12. Okay, Lucia is shaking her head. He goes, I don't know anything about mortgages. Uh, but I'm just saying as an example, I'm not going to figure out a mortgage payment. But let's say if you borrow 2,000, $200,000 a year, what would your mortgage payment be today on $200,000 a year? $1,000 bucks? And again, you guys can figure this out. I just don't want to go into the nickels and the dimes here. Okay. So let's say that $200,000 mortgages costs you $1,100 a month. Okay. If 1,100 times 12, that's $13,200 a month is the cost of the mortgage. Everybody okay with that? But there's $5,000 fees associated with this mortgage, and it's a 5-year term. So that would be 1,000 per 5 years. So this mortgage now really costs you 14,200. You follow me there? So now you tell the clients, here's the cost of this mortgage. You got the interest rate is costing this much. You got all your fees here because it's a 5-year term. We divide that by five. It's costing that amount per year. So this mortgage, if the interest rate was just the interest rate and no fees, this number here would be the same as that number here. In other words, that wouldn't change. But because we have these $5,000 in fee, it's almost like we're adding $1,000 interest to your mortgage every year. This is why this interest rate looks higher.
It's not that it's confusing. It's that we never do, at least me, I never do a 5-year mortgage.
Okay, so what kind of mortgage do you do? Like 1-year terms and so forth?
Normally, very, very seldom I do a 2-year, very
Okay,
seldom.
yeah. So your 1-year term, your mortgages will look really expensive to the clients.
Yeah, they do, but that's the nature of the beast.
That's the nature of the business. So in this case here, if it's like 200,000 mortgage 1 year, and the payments are 11,000, but there's $5,000 in fees, the payment of the mortgage to acquire that mortgage is actually 16,000. So if you do
Correct.
16,000 reverse generated against 200,000 that they borrowed, people are going to say, that's a lot of money to borrow $200,000. It's costing me $16,000. Yes, because these are the fees associated with the mortgage. And whether you're paying these monies in by ways of fees or interest costs, it's still the cost of acquiring the mortgage.
Mhm.
Okay, so this is just showing this is the cost of acquiring this mortgage, taking all fees into consideration. The cost of borrowing the money, which is the interest cost, and the cost of acquiring the mortgage. These are two costs associated with the mortgage. We're putting together in one interest rate to make a nice. And again, they say, why would you do that? Well, because it allows you to compare other options. And it's full disclosure. We're telling you what it's costing this money. It's costing you $16,000 to borrow this money. Well, what does that look like expressed as an interest rate? This is what it looks like of doing that. And again, like it's not easy. It's just a bit like people smell fear, right? If you start doing one of the jigs and dances about it, then it sounds like, okay, you're trying to like tell me something, not tell me something, not tell me the full story. Okay. But if you just say, this is what it is, this is the law, you're lucky you get to work with licensed professionals because we fully disclose to you the costs associated with acquiring a mortgage. We don't hide behind this. The banks have their costs. They work under the Bank Act. I'm a licensed individual here to represent your interests. I have a fiduciary duty and responsibility to look after you. So I'm glad we have this forum in front of us because this just speaks to the professionalism of what we do.
Joe, wouldn't we also throw it in there to the client? This is especially if it's a private mortgage, which 7% is not, but at least it's an alternative to say, hey, we're working now together because we want to create an exit strategy for you so that you can qualify on a more traditional borrowing in the future, because usually people come to us because they have an issue, whatever
Yeah,
that
yeah,
issue.
yeah, absolutely. And like I always, so the great thing about our business, in dealing with our clients is that the mortgage for today is probably not going to be the mortgage for tomorrow. This is the place to get you to your next step, right? And there's always like I'm kind of like I think Sarah knows this a little bit. I'm kind of like a finance guy. I understand money and and that kind of stuff. And I always think there's always the opportunity cost of things. Okay. So if you have to get a private mortgage or an interest rate that's a little bit higher that allows you to get into that home. Okay. So somebody say, yeah, but getting this private mortgage and with, let's use big fees and everything, this thing is going to cost me $8,000 more to get in this home. And you go, yes, it will. Okay. But 2 years from now, what do you expect is going to happen in 2 years from now? Is the home going to be worth more? Okay. So in other words, if it's worth more, it was a good financial decision. If it's a place that you're going to be raising your kids over the next 2 years at a new school, it's a great financial situation because the alternative is what? The alternative is you stay in the neighborhood you don't want to stay, your kids don't go to school they want to stay, and you lose out on owning real estate. Okay? And this is a really, like, I always think this is a really important point. I always tell people in real estate. Money isn't made when you buy the home. Money's not made when you sell the home. Real wealth is created in all the years you can afford to hang on to the home. As long as you can afford this mortgage, you're owning real estate, then it's fine. It's when, unfortunately, some people will put them in mortgages that they simply can't afford. Right? And I think that's the most important thing, when it comes to suitability is can these people truly afford this mortgage? And if they can, well, then get them in this mortgage and then we'll get you out as your life changes. And of course, you have to have an exit strategy. There's got to be a path. Uh, yeah, yeah, I appreciate that, Michelle. There's got to be a path to get you out of here. Right. And this is really like the whole idea of building customers for life, right? Like this is when you start getting their respect, their referrals, and so forth. Like anytime you're doing a B deal, like if I was a broker today, I'd love doing B deals because I know the referrals will be coming through the roof because now you're giving real value in helping people achieve what it is they want to achieve.
Hmm.
Right? And as long as you go with that mindset that I'm just helping people get what they want, and you just want more and more people to help, where it gets out there. I think sometimes the problem with this competitive interest rate environment is we commoditized our business completely, where it's whoever's got the lowest rate. Right? Whoever's got the lowest rate gets it. But the fact of the matter is, and I used to teach mortgage financing for like decades, and Canadians don't understand mortgages. That's the problem. Okay. And the reason why they always ask for the lowest interest rate is because we advertise that all the time. And the number one reason, and this was done by a study in CMHC, is Canadians know nothing, absolutely nothing about mortgages. What other question could they possibly ask? They don't know how to ask any other question. Okay. Most people are
Mhm.
what they're really saying when they call you and say, I want, what's your best rate is anybody out there want to help me get a home? That's really what they're saying, but they don't know how to say that. And then we fall into that trap and we start talking interest rates. Okay. So it's really, and I think, uh, especially nowadays, with refinances and so forth, um, really getting to understand what people like, what makes them tick, asking all the right questions about what matters to them. So as an example, if somebody says, I want the lowest interest rate, okay, I usually respond with this question. Okay, just so I'm clear, do you want a mortgage with a low interest rate or do you want a mortgage where you pay the least amount of interest? Okay. And what do you think the response is for most people? Isn't it the same thing? No, it's not the same thing. There's five elements that make up a mortgage payment, and all of them will affect your interest rate. Or all of it will affect the interest you pay on your mortgage. From payment frequency to amortization, okay? From like even the way variable rate mortgages are calculated from different institutions, this all affects the interest you pay on your mortgage. And they also say this thing, keep in mind there's two interest rates in a mortgage. There's the rate that you get when you get into the mortgage, and then there's the rate you got to pay if you got to leave this mortgage. So we should talk about that rate as well. Okay. So as an example, and I can go on for hours on this car. As an example, we know Royal Bank Mortgage is probably the most expensive mortgage to get out of. Okay, anybody ever try to break a Royal Bank mortgage after 37 months? Very, very expensive.
Mm.
Okay, and I would have articles right in my folder that says, "Look, our RBC mortgage is the most expensive ones to get out of, because it isn't you saying. This is one of Robert Cialdini's methods. Get somebody else to say it. I'm not telling you. It's right here, right in the Globe and Mail every year for the last 12 years. There's a one time a year they talk about Royal Bank mortgages being so hard. Get that article. So you say, okay, now I know how to do the calculation to estimate the cost to get out of an RBC mortgage based on interest rate differential. Okay. It's a little complicated, right? So, but I can do that pretty rough on my calculator. So this is what I would tell people. Okay. If you're competing with RBC and their rate is say 10 basis points higher, The clients are losing their mind because that's 10 basis points higher than your first national rate, as an example. Okay. I would tell clients, okay, and again, clients want to see numbers. I would say, okay, this first national mortgage costs you $17 more a month than that Royal Bank mortgage at a rate of 10 basis points less. So granted, this one costs you $17. But think of the $17 as an insurance premium you paid to ensure that after 3 years, you're never going to have to pay a $36,000 penalty to get out of. This one here would only cost you $8,000. So it's $17 a month insurance premium to ensure you're never going to get stuck with a big penalty. And then show them another piece of paper that says 64% of Canadians break their mortgage midterm for a bunch of different reasons. Okay. So again, it's getting the idea that it's not about interest rate, it's what matters to you. Do you have it? Do you think you're going to move? Maybe you should have a line of credit attached to your product. Like I just did one for my partner Lucy, where her cousin wanted the lowest rate, and there was like 30% loan of value at RBC, and we convinced them, go to Manulife because that product is going to better suit them. Or I don't know, I think we ended up going to Scotia, convincing them because they're young. I said, you think down the road, 3 to 5 years from now, you're going to probably want to buy another home and move up? Yeah, absolutely. Okay. Nowadays, they want to see a deposit of like $100,000. Where are you going to get it? Nowhere. You have a line of credit. You now have the $100,000 at your disposal. You might be in a better competing offer, being able to put a larger down payment. I'm putting you in that situation today. That's great. And it doesn't cost me anything to have it? No. And you're still with one of the big institutions, which is, where you wanted to go. But unless you start changing the conversation and doing stuff and asking questions about it, then we're stuck in that rate game. The key too is that the APR is an annual percentage rate. We know mortgages are calculated semi-annually, not in advance. Okay. So you might have a question, oh, Joe's out to lunch because this interest rate is like 5.25, and this interest rate down here is 5.31. Why is it changed when there's no fees? Because that's the 5.25 converted to an annualized interest rate of 5.31. Okay. So like a 6% mortgage compounded semi-annually is actually 3% per year. Well, 3 compounded to 3 is 6.09. So that number at the bottom would show 6.09 is the true cost of borrowing a mortgage. So it's kind of funny because even if there's no fees, people think they're paying like a 3.99% mortgage. They're not. They're paying a 4.02% mortgage. That's the true cost of borrowing that money. Okay, because mortgages are kept semi-annually. And now, in case of variable rate mortgages, in some cases, TD being the most notable, it's compounded monthly. So if you have a variable rate of 3.99 at TD, you're not paying 3.99. Okay. So then now you can get your variable rate mortgages from Scotia, which are semi-annual, to those that are TD that are semi-annual. Okay, these are, I think, the important conversations to have with your clients so they understand this guy is the professional when it comes to mortgages now. Now I know why. Okay. And believe me, I would have people like I would be playing hockey and different, not even fully dressed, and I'd have guys drag a guy across. If you're getting a mortgage, you got to talk to this guy. This guy's the only guy I know who knows anything about mortgages. Okay. And knowledge is powerful. Just keep on acquiring that knowledge and learning more about it. And maybe like the Seneca days of teaching and all the mortgage financing course, all that stuff is gone. They got rid of that out of the curricula. Okay, they went back to just that weekend course. Everybody becomes a broker. Um, but I kind of wish those days were back. And there's a lot of guys like I don't know if some of you guys know like Jim Terlucas and some of these high performing guys in our space. A lot of these guys went through like my program, and I still love running into them because they say, man, all the knowledge, like it's not so much the knowledge I gave them, but them understanding it and then kind of took that knowledge and added more knowledge to it. Say that just took us to a whole new level. Really understanding our profession is so important to really build a solid business.